Hello, I'm Matt Lampert, the Director of Research at the Socionomic's Institute, and welcome to this Introduction to Socionomics video series. You are on the cusp of getting a perspective that few people know about, and as a result, you can have an edge in your marketplace by being able to understand trends and even spot the potential for their reversal, unlike just about anyone else. So today we're going to cover the essence of socionomics. This is going to be big picture stuff. So let's start by looking at some headlines. Japan stocks fall, yen keeps funds in bearish mood. So what's the presumed chain of influence here? We've got falling stocks in Japan, something going on in the currency market with the yen, and the presumed result, a negative mood, a bearish mood. U.S. earnings, ASML, sour mood in Europe. So some earnings reports come out in the U.S., they're not as good as expected, and the presumed result, a sour mood, a negative mood on the European continent. Now these headlines are illustrative of the idea that financial events, economic events, political events, or in short, social events, influence the tenor and character of social mood. This is precisely the sentiment we tend to see in the popular press. It's also precisely the sentiment that we tend to see in the academic press when the subject is broached, and in our view, it's precisely backwards. We look at how social mood influences the tenor and character of social events. That's the essence of Robert Prechter's socionomic theory. We start with the psychology, because these events have to come from somewhere, and they come from people who have feelings. So if you know how people are feeling, then you've got a leg up on anticipating their actions. And really, this is basically diametrically opposed to the conventional view of understanding the relationship between mood and events. So let's look at some examples. The standard view would say that recessions cause business people to become cautious. Well, the socionomic view is the reverse. It says that cautious business people cause recessions. The standard view might say that talented leaders make the population happy. Well, in socionomics, we say it's the reverse. A happy population makes leaders appear talented. Epidemics cause people to be fearful and depressed. Well, it's the other way around. Depressed and fearful people are more susceptible to epidemics. So in socionomics, we always start with the psychology, we start with the mood, and we use that as a basis to understand the tenor and character of social events. Now, it's been fascinating over the past 10 or 15 years to watch more and more people say things that align with the socionomic perspective, and some of them didn't even realize they were thinking socionomically at the time. For example, Alan Greenspan, the former chairman of the U.S. Federal Reserve, went on The Daily Show with Jon Stewart in 2007, and he said this: "I've been dealing with these big mathematical models to forecast the economy. But if I could figure out a way to determine whether or not people are more fearful or becoming euphoric, then I don't need any of this other stuff. I could forecast the economy better than any way I know. The trouble is, we can't figure that out." Or can we? If you're interested in the Elliott Wave model, you might be interested to see what R.N. Elliott had to say about this very topic. In his 1938 book, The Wave Principle, Elliott wrote this. He said, "Human emotions are rhythmical. They move in waves of a definite number and direction. The phenomenon occurs in all human activities, whether it is business, politics, or the pursuit of pleasure. It is particularly evident in those free markets where public participation in price movements is extensive. Bond, stock, and commodity price trends are therefore especially subject to examination and demonstration of the wave movement. This treatise has made use of price movements in stocks to illustrate the phenomenon. But all of the principles laid down herein are equally applicable to the wave movement in every field where human endeavor is registered." Wow, so in other words, when you look at a stock chart and you see an Elliott wave pattern, Elliott's saying what you're really seeing here is the rhythm of social psychology. He used the word emotion. We prefer to use the word mood because emotions are usually short-term in nature. They're a response to a stimulus, but mood, that's more diffuse. There's no stimulus involved, and so it's free to fluctuate up and down at all time scales. And Robert Prechter makes the argument that stock indexes are especially good meters of mood because, yes, it's a place where traders can express their changes in optimism and pessimism, but it's also a venue where they can do that quickly. If you're feeling more optimistic, it only takes a few moments to bid up the price of a stock. It just takes a few clicks of a mouse or a call to a broker. And the opposite, if you're feeling pessimistic, again, you can execute that decision very quickly. But in other areas of life that are mood motivated, decisions take longer to execute. So someone who's feeling more optimistic might choose to bid up the price of a stock, but someone else who's feeling that optimism at exactly the same time might express it by, let's say, going out and opening a business. Well, the person who trades a stock is done in 30 seconds, but the person who wants to go out and start a business, gosh, that's going to take so long. They have to design a business plan, maybe come up with a prototype or a product, hire staff, design a marketing campaign, and by the time they're finally up and running and the business is going and contributing to, say, a data series like economic growth, well, that could take months. So that decision takes longer to show up in the data than the stock trade. So what this means is that if we have the stock market, we can use that as an indicator of social mood and use it to understand and even forecast some of these other areas of social expression where the decisions take longer to execute. Let's look at some examples. This is a chart from Robert Prechter's work. On the bottom, we've got the Dow Jones Industrial Average, and we've plotted that against the number of U.S. patents granted. Now, patents are a sign of technological innovation. If someone's feeling more positive, more optimistic, they might express that by going out and inventing something. But it takes a long time to get a patent. You have to design a prototype, turn in some paperwork, it has to get reviewed, it could take 2 or 3 years. So what that means is that if we look at this data series, what you'll find is that the peaks and valleys in the market tend to happen first, and then they show up later in the patents data series. So for example, look at this stock market peak in 1929. Well, it aligns pretty well with this peak in patents, but since patents take so long to get, it shows up in the patents data series a little bit later. And you can use this for all kinds of stuff. Here's another example from Prechter's work. Popular music styles shift with social mood. When people are becoming more optimistic, they're more inclined to listen to happier pop music, more upbeat, more up-tempo. You hear more major keys. And when that psychology changes, so does the preferences and the behavior. When psychology is negative, when social mood's trending negatively, that's when you hear more pessimistic lyrics, harder edge sounds, that kind of thing. And to answer Alan Greenspan's question about when are people more likely to be euphoric and set off some of the great asset manias of history, well, this is something that Robert Prechter has written about. This is a chart from a study that Prechter did with Alan Hall, and they found these asset manias tend to occur during terminal waves in the Elliott Wave pattern. In other words, times where mood is the most elevated, when it's the most ebullient, most optimistic, most jubilant, that's when people are inclined to bid up the prices of financial assets wildly. And by the way, when that psychology changes, that's when you get the busts. And it's not just the past that you can understand from a socionomic perspective. You can use socionomics in real time to understand the present and even anticipate the future. And in our next installment, we're going to talk about how to use socionomics in real time to spot risks and opportunities. It should be a lot of fun. I hope you'll join us.